Good morning. It is Monday, May the 4th. Here's what's on the agenda. Oil shrugs on Trump's plan to help ships through Hormuz. AI drives stocks higher again. And European leaders meet amid Trump threats on tariffs and troops.
Morning, Tom. Let's talk about which markets are open and which markets are not. The UK, Japan and China are all closed. Bear that in mind when you think about what's going to happen with liquidity today. As you say, Brent Crude largely shrugging about this regarding this story that the US is going to shepherd tankers through the Strait of Hormuz. We're not seeing much reaction. We're down a little bit, 0.9% right now. Euro Stoxx 50 futures, the UK is out. We're up by around 0.5%. Keep an eye on what is happening with tech. Apparently CTAs are programmed to sell this week, which will be interesting in terms of that tailwind disappearing. The big story this morning, though, could be this one. Dollar yen. We are down a little bit this morning. It is possible, take a look at the chart, that the Japanese have been in again this morning. The UK is out, Japan is out. Light liquidity in the FX space. That could be a story to watch as we work our way towards the opening trade. The countdown to which starts right now.
So, no US attacks on Iran over the weekend. That had been one of the risk factors for these markets. Instead, we have a plan from President Trump and the US military to help some of these ships through the Straits of Hormuz. It seems that US vessels may be involved, US aircraft and US drones as well. But significant questions in terms of how this materialises remain. Do investors look at this as a US administration digging in terms of their blockade and looking for additional solutions? As we think about timeframes, Scott Bessent says we are potentially weeks away from Iranian oil wells capping out. Timeframes so consequential when it comes to what's happening with the Straits of Hormuz. Do we look at the meeting in 2 weeks between US President Trump and Xi Jinping? Is that the timeframe to think about? Or is this a US administration, again, looking for solutions as they continue a blockade of the Straits of Hormuz?
The market is, you said firstly this morning, I was shrugging its shoulders. It's oil's down a little bit. The initial headline when I saw it this morning seemed to indicate a significant military action, that the US would be basically shepherding tankers through the Straits of Hormuz. That is not the case, apparently. Certainly the journals pushed that line fairly hard this morning. So if it's not that, what is it? And if it's not a significant breakthrough, are we back to where we started and where we were Friday? And that appears to be the market narrative first thing this morning. This is not a big evolution in this narrative. All the other factors are really hard to tell right now. All we know this morning is that the Strait is still closed.
The Iranians came out, said that this could potentially upend the ceasefire. So we look at their response. The Chinese response, very interesting as well, in terms of these sanctions on Chinese refineries. Dusting off a rule that they haven't used before. So a major pivot from the Chinese authorities telling those refiners not to abide by US sanctions, where previously they'd looked through that. So this is a markup in terms of the Chinese response, again, ahead of that meeting between the two presidents. For the markets, though, it seems like, at least the equity markets, still the only trade in town is what's happening with AI. And you're seeing reflected in the Asian session again, Guy.
It's interesting. So we've led this morning with oil. Is that the story? Or is the fact that we're seeing a huge story, as you say, develop in Asia once again? Concentration manifest all over the place at the moment, particularly in Korea, particularly in Taiwan. Chip stocks in particular are being pushed sharply to the upside. Again, which one of these two narratives is the most important? We've led with the fact that the oil story is the most important this morning, but you could argue that it isn't. But the concentration risk just gets greater and greater around this trade. Is it something that is sustainable? It's going to be interesting this week. CTAs are programmed to sell, apparently. There's also stories floating around about hedge funds not being quite so sure about this tech rally. What is driving it? How much more concentrated can it get? And if it starts to roll over, if the oil side starts to sort of be the greater threat, do we start to see a rolling over of that trade? But it's so fascinating how tight that trade has now become.
On that concentration risk, then, the S&P 500 on track, those companies that have reported so far in the first quarter, to come through with earnings growth of around 27%. Of that, Mag 7 companies making up almost 60%, 57% earnings growth from the Mag 7 companies, 57% earnings growth from the Mag 7 companies that have reported so far. For many, that is validation, at least for now. But to your point, the inflation risks, the pricing risks, and the risk of re-rating on the back of what's happening in the geopolitics has to be something that investors factor in.
What is happening with cash flow? What is happening? What is driving this AI spend story? Increasingly, it feels like a debt narrative. If you've basically got a sector that is spending huge amounts of money, debt-driven, is that something that can carry on for a while? So, yes, the earnings look OK for the moment, but A, they're very concentrated, and B, increasingly it feels like this AI build-out is being driven by debt, because you take a look at what is happening with the cash flows, look at Amazon and various other companies, they are beginning to struggle to drive this out of existing businesses. And if you do see a rollover, are you going to see companies like Meta being able to sustain this kind of tech spending? I don't know, but the market at the moment is taking the glass half full part of that narrative.
Certainly, and we saw that divergence, didn't we, between Alphabet and Meta as there is more scrutiny. Some would see that as a healthy reaction from the market in terms of how they pass the results from companies that are spending more, borrowing more, versus those that are really seeing the results and the earnings coming through. All of this factoring, we have to think about the costs as well. The Financial Times come through with an interesting report from the automakers stateside in terms of the potential $5 billion hit from the impact of higher commodity prices that they're starting to factor in, on top of about $6 billion in terms of the tariff impact. Meanwhile, European leaders having to face up as well to additional threats from Trump.
So EU leaders are arriving right now. I don't know if we can show you some live pictures that are coming through from Armenia right now. EU leaders are gathering this morning. They've got so much on the agenda. They've got so much to talk about. They've got an energy crisis they need to think about and resolve. But they've also now got this threat coming through, this threat being generated by the Trump administration, multi-pronged threat, one on the military side, i.e. we're going to be potentially withdrawing troops from NATO bases, particularly in Germany, but elsewhere potentially as well, Italy and Spain. It's interesting that potentially we are going to see the US administration sending people to Italy to maybe resolve what's happening there. And then you've also got the tariff threat, to your point, about what's happening in the car sector. So the EU leaders are gathering once again, having this energy crisis to deal with, but also facing this very aggressive the series of Trump threats.
The EU exports around 800,000 units of vehicles into the US market. We're talking of tariffs going from 15 to 25%. We'll see if that is, in fact, enacted. So we're waiting for their response to that. We're waiting for their response as well, as you said, to the cut to troops, US troops in Germany, with President Trump saying more could come through as well. It's worth noting that Congress may play a role there in terms of constraining the president. But top line, fewer troops in Europe, fewer US troops in Europe. And that is a win for Vladimir Putin as well, geopolitically.
You would argue, but to your point, in the past when Trump has threatened this, it hasn't been delivered upon. So maybe actually what European leaders do today is say, we will wait to see whether there are additional auto tariffs. Is the reality there? We will wait to see whether troops are withdrawn. Is the reality there? Because this could just be bluster and threat and actually not turn into very much. So maybe we wait and we watch. We've got a lot to talk about on the show. There's that EU factor that we need to fold in to these markets. And Pierrakakis, Eurogroup president and Greek finance minister, will be joining the show shortly. Ollie Crook will be talking to him. We'll get that take. Dan Scott, Vontobel CIO, is going to be joining us out of Zurich as well. And Roxanne Farmamayan, University of Cambridge lecturer in international politics on the Middle East, will be joining us later in the show to give us a take on what is happening today in the Gulf and how we should think about what could happen tomorrow in the Gulf and whether or not we can connect those two dots.
Here's what else to think about then throughout today and this week. Today, Eurogroup meeting in Brussels. So, yes, you have EU leaders meeting in Armenia, and then you have FinMin ministers meeting, financial ministers, in Brussels as well. So we'll keep across that one for you in terms of any response, anything significant that comes out of those meetings. On Tuesday, the ECOFIN meeting in Brussels, plus you get the European bank earnings from UniCredit, HSBC, Banco de Sabadell as well. So a big day for European bank earnings. And on Wednesday, G7 trade ministers meeting in Paris. And then we get bumper earnings day with results from the pharma, consumer and tech sector as well. And on Thursday, political risk in the UK local elections. And on Friday, the labour market of the US, non-farm payrolls, US jobs reporting as well. As we think about the Fed's response, and Kevin Warsh likely, of course, to be the head of the Federal Reserve, with markets still pricing in a couple of cuts, despite the dissents we've had from three members of the FOMC suggesting they're uncomfortable with that easing bias. So the labour market will be in focus for us this week.
But if you look at the latest data out of the US labour market, it looks incredibly strong. You look at the latest claims numbers, very, very strong. Is there a case for Warsh to cut right now? I think it's hard to do that with the PCE data where it is right now, north of 3%, with the labour market that looks fairly strong. It looks like the inflation threat is definitely there. So, yeah, it's going to be interesting to see what confirmation we get from the non-farm payroll numbers. But look at healthcare. Healthcare is holding up the US economy right now? How healthy is this labour market really?
Healthcare and AI. But to your point, PCE is what, 3.4%? You've got growth at 2%. You've got the labour market looking relatively strong, and you've got a Fed that hasn't met its 2% inflation target for over 4 years. So how do you make the case for cutting in that environment? And what will the market reaction be if you have to fade out those 2 cuts? More than 2 cuts that the markets are still pricing in for the Fed. How much of a re-rating would there be for the equity markets on the back of a fading of those cuts, if indeed that's what comes to pass?
The US economy is a bit like the US stock market. Very concentrated around AI spending. A lot of that is the big driver of what we're seeing in terms of growth. It's a factor that if it were to turn, maybe Walsh would get his rate cuts quite quickly, but maybe if not for the reasons he's hoping for. What else do you need to know this Monday morning? The UK is set to enter talks to join the European Union's €90 billion Ukraine loan programme. The EU finally gave approval for disbursement of the loan last month, remember, after Hungary lifted its veto following Viktor Orban's election loss. Bloomberg has reported that the UK and the EU are advancing discussions to let Ukraine buy British weapons with the bloc's loan. Berkshire Hathaway's cash pile soared to its highest ever as operating earnings jumped in Greg Abel's first quarter as CEO. After a slight decrease last year, the cash hoard has now jumped to $397 billion. Abel also resumed buybacks, handing shareholders a payout for the first time in more than a year. Berkshire shares have slipped since Warren Buffett's announcement last year that he was retiring. And get this, GameStop is making an unsolicited offer to buy eBay for about $56 billion in a $125 a share in cash and stock proposal. GameStop CEO Ryan Cohen would serve as the CEO of the combined company. GameStop has a market value of $12 billion as of Friday. $12 billion. eBay is of course much bigger at around $46 billion, though the game retailer has around $9 billion in cash, which is worth factoring into the enterprise value. OK, coming up, we're going to take a look at the stocks to watch at the open, including European automakers after President Trump's latest tariff threats, plus Spirit Airlines collapses as further cracks grow in an industry navigating, of course, that spike in jet fuel costs and a shortage of supplies. We discuss the latest fallout from the war in the Middle East. Up next, we'll be joined by Tom Watts, portfolio manager at Julius Baer, how to navigate these markets and the geopolitics. If you have any questions of your own for our guests, send them to us. IB plus BBTV Go. This is Bloomberg. We are a little under 45 minutes from the opening trade. The UK markets closed, of course, for the bank holiday. European futures, though, pointing to a decent start to the week, up 0.4%. You're seeing the gains coming through there across the benchmark. DAX futures pointing higher by 79 points, despite this threat of additional tariffs coming through from the US administration. And CAC 40 futures over in France, looking to add about 0.5%. President Trump, meanwhile, saying the US will begin guiding some neutral ships trapped in the Persian Gulf out through the Strait of Hormuz. US Central Command said Sunday it would provide military support, including guided missile destroyers, aircraft and drones. Let's bring in Bloomberg's Jumana Pasechi in Dubai. Jumana, do we know how this plan will work in practice and how markets are going to responding, or at least how traders, oil traders, are responding to the details of this?
Well, here's what we do know, Tom. President Trump said as of today, the U.S. would start guiding stranded vessels and has framed it as Project Freedom, as a humanitarian initiative. And certainly there is a humanitarian necessity to get some of those vessels out of the Persian Gulf. They've been stranded there since the beginning of the war. It's estimated that there are about 800 ships just sitting there, 20,000 seafarers facing pretty dire conditions, extreme stress, fatigue, food and water shortages. So, yes, most certainly there is a humanitarian need to help those that are trapped there. Now, the question is, on details, we don't actually have a whole lot of details. CENTCOM did say that they would be included in the initiative. They would provide missile destroyers, more than 100 aircraft and 15,000 service members. But at the same time, at the top of this, you heard me say the U.S. will guide as opposed to escort. And media outlets overnight, Wall Street Journal and Axios, are reporting that there will not be U.S. naval escorts being provided to these stranded ships. And a short while ago, even the French President Macron is saying that France will not take part in this new plan as well. So unclear whether there's going to be international participation or indeed any naval escorts involved. And at the same time, the Iranians have already come out threatening with a post on Truth Social. This was put out by the head of the National Security Commission in Iran's parliament, saying any American interference in the new maritime regime of the Strait will be considered a violation of the ceasefire. A few hours after President Trump put up that Truth Social post, the UK Maritime Organization actually reported targeted projectiles once again at a vessel that was just sitting off the coast of Fujairah. So once again underscoring the risks and the dangers surrounding any vessels that are still around the Persian Gulf. And I guess the question here is whether there is going to be any take-up and whether any ship owners will be incentivized to cross the strait, given that the role of the U.S. Navy is less to provide escorts and more to coordinate and to tell them which of the safe routes to pass on. Now, bigger picture, of course, we're still awaiting whether there can be the divide between the U.S. and Iran, this 14-point proposal that Iran put forward to the U.S. Iran are saying that they've received a response from the United States, whether there's enough in there to actually proceed to the next round of negotiations, because phase one does come back to Strait of Hormuz. Iran are proposing a mutual lifting of blockade and then deferring the nuclear discussions for later. Is there enough in that proposal to bring the two sides together? That is something else we're watching out for this week.
Joanna, great stuff. It's going to be a busy week. It's already started, and we've got plenty to think about. Thanks for updating us. Joanna Basechi joining us out of Dubai. Crude is currently trading. Brent 107.43, down a little bit, but not by much. Seems to be largely, as Tom said at the top of the show, shrugging its shoulders about what is happening here. So what do you do this week? What do you focus on? What should you be thinking about? Is it what is happening in the Gulf, or is it this ongoing and increasingly concentrated AI trade that seems to be driving markets around the world? Tom Watts, portfolio manager at Julius, Baer, joining us now to talk about this. Which one? What do I focus on this week? Is it tech, or is it what is happening in the Strait of Hormuz?
I still focus very much on what's going on in Hormuz, although tech has been driving US markets, maybe the last week or two with earnings coming out. Actually, the overarching story is still oil, isn't it? I mean, we're still looking at rate cuts, we're still looking at inflation around the world, and that's going to be
rate cuts.
Driving. Rate cuts, rate hikes, well,
rate
perhaps.
Hikes.
But rate cuts, I think we're still very much looking at Julius Baer. It's obviously oil markets are going to be what's driving that, I think, at the moment.
How does that manifest itself? Because at the moment, as you say, equity markets are pushing ever higher, though you do have bond markets around the world sort of sounding a little bit nervous. US 30-year circa 5%. UK bonds, we'll talk about maybe those in more detail in just a moment. Sure. Do I look for the threat that comes from the Gulf through the bond market lens?
Well, it's an interesting one, actually. It's sort of reciprocal in a way. We've seen it before with Trump and bond yields. If that 10-year does go over 5%, we saw it with that kind of taco trade, if you like, with Liberation Day last year. Maybe if actually bond yields get to a certain point, you'll see Trump really pull back and start to try and negotiate.
Is there a point that would worry you? Are we there yet?
I don't think we're there yet, but actually, as I said, I don't think it would worry me. I think it would actually comfort me that these things have a big impact on Trump's thought process. So actually, perversely, if we do get higher bond yields, it could mean that actually peace in the Middle East comes a bit quicker.
Are the equity markets set for a pretty violent re-rating once the inflationary impacts of this conflict really come to bear in terms of higher prices and supply shocks?
I think at the moment, I wouldn't say violent was the case. We've seen with oil about 120. It's obviously spiked that, come down a bit. The longer this conflict kind of carries on, the more it's difficult to try and price in rate cuts. But at the moment, I think we shouldn't be in for too much of a violent re-rating. As you said, it's mostly driven by tech, and that seems to shrug its shoulders at oil prices.
Where do you see those cuts coming through from?
So we're a bit of an outlier at Julius Baer. Yeah. We still see cuts in the US and, in fact, the UK coming through this year. We think that the war in Iran should be coming to an end fairly soon. I think it's getting more and more difficult each week to try and justify that, but we're still very much of the view.
So how many cuts for the US, and how do you make that forecast on the back of, as Guy and I were discussing, pretty robust labour market, growth at 2%, inflation, PCE north of, 3.4%, around 3.4%, certainly well above the Fed's target?
Well, I think if we get a conflict, we get into the conflict relatively soon, actually oil should start coming down. We'll be pricing in oil about $80 if that does happen. And then you've got, obviously, Trump putting pressure on Walsh. I mean, I think Trump at the moment is probably the only man who's expecting a rate cut in the summer. But actually, if we do get kind of end to this conflict quickly, Walsh, I think, is pretty dovish of the way he looks at things. We've had a few Fed governors out already who have been very hawkish. We had Kashkari out yesterday who was saying, actually, I don't see a rate cut anytime soon. But there could be one if this conflict ends quickly. I think that's
so you're basing... You are assuming that this ends soon?
Yes, that's our assumption.
But as you say, it is becoming harder to justify that. At what point are you going to have to say, actually, we're near or at the point of no return, where actually the damage economically is going to be quite significant, the inflationary threat is going to be quite significant? At what point do you say, actually, I need to start factoring in a continued war into my outlook?
I think by the end of the summer, if we get oil prices continually over $120 a barrel, then, yeah, I think that's a worry for us.
120?
I'd say about 120, but, I mean, that is...
We're 107 this morning on Brent.
Yeah, we're 107 on Brent. I mean, it's still obviously a worry if we get to 120. I think that's really difficult, and we can sort of piece it back to 2022, and when Russia invaded Ukraine. Oil prices were around that level, and it was difficult. But I think we should see oil start to make... Do you think
there's a danger that we cut for the reasons that actually... that it's not over? That the war continues, that actually that produces cuts, because in some ways what this is a big tax on the global economy, and that the economic damage is going to be kind of greater than the inflationary threat that could potentially be out there. We
could see that, but I don't think that'll be any time soon. I think governors, especially at the Fed and those at the Bank of England, have mentioned several times they'll try to look through this inflationary spike as much as possible and won't be moving anytime soon. But I think we should get movements towards the end of the year, up or down, depending on oil prices.
Well, back to the AI story. Are you worried about the concentration in terms of the gains that come through from the mega tech names, or is this a tide that lifts all boats?
I think it's a tide that lifts all boats. You've seen that in the US. We're not too worried about that concentration risk. We've had this story now for years and years about the Mag 7 coming through. Again, sort of going back to rate cuts, we believe that actually, when you get these coming through, which we still believe will come, actually you'll have this market rally start to broaden out again. I think it's very much a question of timing, that you've had all this geopolitical kind of tension happen. At the same time, you've had really strong earnings come through from Mag 7. So that sort of diverted investor attention back towards the Mag 7. It's almost a kind of, hey, you forgot about us, we're still doing very well, earnings are still coming through. So, yeah, we expect investor attention to turn away from that again.
The market's very narrow, though, at this point. Again, I'm just kind of wondering, as a portfolio manager, as you think about what is happening here, is this a story I can ignore? Do I have to be part of it? How do I trade it? Do I worry about the concentration risk? How do I hedge risk in a portfolio that is increasingly looking like it's focused on just one area of growth, that increasingly feels like it's also debt-driven?
Yeah, well, in our portfolios, we tend to go passive on the US anyway. It's a well kind of trodden path that investors believe it's very difficult to keep creating alpha in the US for fund managers. So we've gone passive. We own various different instruments in the US that sort of hedge against this. So we've got a passive S&P 500 tracker. So you've got, obviously, decent natural exposure through that anyway in the Mag 7. We've also got an equally weighted alongside that as well, that's sort of, ready for that market rally to broaden out.
OK. Tom Watts, Portfolio Manager at Julius Baer. Thank you very much indeed. Well, that take on how to think about positioning and the view that there are still cuts to come through when it comes to the Fed. We didn't touch on the UK, but, of course, political risk and how that's priced in or not priced into gilts is going to be a factor this week as we lead up to those midterm elections, of course, consequential, arguably deeply consequential for the UK Prime Minister as well. OK. That's going to be a factor that we're going to watch, into Friday? We're not really allowed to talk about it Thursday, but Friday morning could get very interesting for the gilt market. Yes, indeed. And to your point, how these different the impacts on the UK of inflation are stark. They are in Europe as well. We've seen this divergence in terms of European stocks versus US stocks. Does that continue? And how does the rates... Europe is being hurt by the oil story in a way that the US isn't at the moment. And now it's got the tariff risk. Coming up, EU finance ministers gathering in Brussels. We bring you the latest. Stay with us. This is Bloomberg. Minutes to go until the start of trade here in Europe. Remember, the London is out today, so we are going to see lighter volume than normal. Treasuries are going to be closed until a little later on today as well, with Japan and the UK out. Keep an eye on what's happening in the foreign exchange market, though. Lots of action in the yen. So Euro Stoxx 50 futures up by around 0.5%,
It's going to be interesting to see whether tech is a feature of that landscape.
Yeah, more action in the equity markets and the FX markets than there are in the bond markets right now, as we check in on European bonds trading, of course, in the session. Largely unchanged when you look at German debt, as you can see, 3% on the benchmark 10-year. French OATs at 369, also unchanged. Italian BTPs at 385. Meanwhile, EU finance ministers set to gather in Brussels today to address the impact of the Iran war on the European economy. It comes amid escalating political and trade tensions between US President Donald Trump and European allies. Let's bring in Bloomberg's chief Europe correspondent, Oliver Crook, who's standing by in Brussels. Ollie.
Yeah, that's right. A long laundry list of issues to deal with here at the European level. Either some short-term issues, medium-term issues, long-term issues. Of course, the energy crisis is really monopolizing attention, but we've also got a number of other issues, including defense spending. And now, new news over the weekend about a trade war potentially reigniting with the United States. We're very pleased to be joined by Kyriakos Pierrakakis, who is the president of the Eurogroup and also the finance minister of Greece. Sir, thank you so much for joining us this morning. Can you explain to us what exactly your understanding is of the threat that has been put forward now by Donald Trump, why it's coming now, and what the European response should be?
First of all, I'm delighted to be joining you, Oliver. And needless to say, I think this discussion that's currently taking place is quite unnecessary and quite unfortunate. The last thing the global economy and the European economy needs right now is an extra layer of uncertainty on top of what is happening in the Strait of Hormuz and in the Middle East. And needless to say, our side of the bargain has been fully met, has been fully kept with regards to the joint statement commitments and the legislative timetable which we had in order to pass them. We have met all prerequisites in this equation. So in this regard, our number one choice always is dialogue. We want to be a predictable partner in the international economy. We believe in the transatlantic relationship. We consider it to be important, existentially important for the world. But having said this, if there is a deviation from what we have agreed upon, obviously all choices will be on the table, all options will be on the table.
So that is to say that retaliation is on the table. There's also potentially suspending the deal, which we saw the first time when there were tariff threats made on Greenland. But is there also an alternative in which they accelerate the ratification process? This has been one of the big frustrations from the United States, is that till to this day, despite the fact that the trade deal was agreed to in July, it has still not been implemented.
As I said, dialogue is our number one choice, our number one option. And we want to keep our side of the bargain. The legislative timetable is well known on every occasion at the European level. So we're hoping to meet that because, as I said, we want to be predictable partners and predictable players in the international economy. So that's option number one. What I'm saying is, if we deviate from this, if an extra layer of uncertainty comes into the table practically, not only in terms of vocabulary, then obviously we will have all options available. But we're hoping not to reach that point because it's existentially important to coordinate, collaborate, and keep an open channel of communication with the United States.
And is the trade deal implementable despite the fact that there are still these steel and aluminum tariffs that some of the EU is saying are in contravention to the deal? Is that still an implementable deal from your perspective?
I mean, we want to ratify the deal that has been defined in the joint statement. So the idea is that everything shall be implemented. That was the plan all along. But having said this, it's quite problematic, let me repeat the original point, to add layers of uncertainty right now, because there is a dire impact in the global economy from what is happening in the Middle East.
You say that the legislative process in Europe is well advertised, but is the legislative process and the speed at which it operates, is that a problem?
Generally speaking, we need to speed up. We know that. But having said this, there is predictability on our end. And I think that predictability at the end of the day, be that the tariff discussion or be that our legislative process, is far more important than the processes and the policies themselves from the standpoint of the global economy. You need to be a predictable player. And we are. And I think there is a premium in being a predictable player.
And something that has been unpredictable is the price of energy recently. And this is going to be one of the main topics for you. I'm speaking to finance ministers a little bit later today. Can you give us a sort of your appraisal of the severity of this energy shock here in Europe? And we've heard from the central bank governor of Greece saying that recession is a real risk here in Europe. How big of a risk is recession in Europe?
Well, there is a stagflationary tendency. That's obvious. Our projections of growth are downwards looking. Our projections of inflation are upwards looking. So in this regard, the tendency is stagflationary. But I will agree with Christine Lagarde that we're not yet in the 1970s perimeter. Obviously, this is a function of many things that can happen in the Middle East. It's a function of the duration of the crisis, the severity of the impact vis-à-vis the energy assets once the straits are fully open as before in the ex-ante equilibrium. And finally, it's also a function of the status that we will see in the Strait of Hormuz after and what type of integration you will see in the risk premia. all governments are taking measures. The European Commission has advanced a perimeter of acceptable measures which should be targeted, tailored, and by definition temporary. And the IMF is also joining us today to make an assessment of those measures, also from the standpoint of what worked and what didn't work in 2022.
And I want to get into some of those measures, but first I'd like to just get your appraisal at the top line. When you think about the sort of trade-off between rising inflation, diminishing growth in Europe, which is a bigger threat, do you think, to Europe at the moment? I
don't think we should be ranking them. I think both are threats which exist on the table. And again, we have uncertainty in this equation. And that's the biggest problem, I would say. We have various scenarios which we're studying. Europe is much better prepared compared to 2022 with regards to those scenarios. I mean, if you look at energy, we're more diversified than 2022. We have invested more in grids than 2022. Should we do more? Yes, we should do more in this regard.
And part of your function today in having the conversation with these finance ministers to appraise what measures that have been taken that have been functional, which have been less functional. Do you have an idea of what has worked well in sort of dampening the effects of this energy crisis and are appropriate at the national level, and also what needs to be done at the European level? We've heard some dissatisfaction from some leaders relaxing or having some flexibility on debt rules, for example. Is that on the table?
Well, first of all, the measures that have worked are the ones that are most targeted, that fit the perimeter that I described before, targeted, tailored, and temporary. And we know that we should be helping those who are most in need. So those are the measures that worked best in 2022. They are the measures that work best today. Most countries are implementing them at the moment. We should implement more of them should the crisis persist. Now, what should be and what shouldn't be on the table at the European level? I think that right now, what we're doing is the proper, I would say, we have a proper analysis of the state of play. We have the proper response at the European level. Why? Because you don't want the energy crisis to fuel a fiscal crisis at the end of the day. We have new fiscal rules in place. Generally speaking, the debt levels, the deficit levels, they are higher compared to 2022, and we have already had the escape clause with regards to defense. So all of those things need to be taken into account. But having said this, the European response should be a function of the severity of the crisis that we have in front of us. We have a different discussion if the crisis persists for another 2 months or 3 months, or if the crisis ends in the next couple of weeks.
So if I understand you, at the moment you don't think it's appropriate to extend, for example, the escape clause to the energy shock right now, but that is something that could be a conversation in the next couple of weeks and months.
What I can tell you is that at the European level, the conversation will evolve as a function of the severity of the crisis that we will have in front of us. But given the state of play, the European response is the appropriate one.
And I'd like to get your appraisal of something that we've seen that's sort of outside of your remit, but the consequence it will have for fiscal policy. The United States says that it's going to be withdrawing 5,000 troops from Germany. Obviously, this puts more sort of pressure on spending and defense at the European level at a time with, as you mentioned, there is much more fiscal strain. Is this going to reanimate, do you think, a conversation about how to pay for all of this defense spending and reanimate a conversation about joint debt for defense?
No, we have already taken measures with regards to financing defense. I think this is existential. This is Europe's moment of truth, in a way. We need to decide whether we're going to be a single market or a global power, what type of status we will seek. And I think we should seek the latter. Russia's invasion in Ukraine manifested the need for that. Defense is a common European public good. And in this regard, we already activated the escape clause. Greece was amongst the first countries to sign the activation of the escape clause nationally. We have created instruments like the SAFE instrument at the European level. Can we do more? Yes, we can. We can do joint procurement, for instance, much more compared to what we previously did. And there can be many spillover effects in the economy should we be doing that. Generally speaking, I can tell you that defense is certainly one of the core priorities. And it's quite interesting, Oliver, that many of the topics that we're discussing, be they energy, be they defense, be they technology, they're integrated in the debates of the European finance ministers right now, because we seem and we must to be focused on a full scope, on a full spectrum of issues which touch upon the finance minister portfolio, because the job itself has evolved because of the crisis that we have in front of us and because of the challenges that we have in front of us.
And thinking about the broader picture, the long-term future of Europe and sort of unlocking some of that firepower, of course, the sort of low-hanging fruit we've been talking about for many years is the Capital Markets Union, Saving and Investment Union, or whatever name we're sort of going with right now. How close are we to making any kind of significant progress there? There's still a big question on supervision. Can you make any progress without having settled that question?
We can certainly have progress quite soon. I think we're close to having very significant progress. The market and supervision package is one such manifestation. We need more centralized supervision in our capital markets. And, it's one of those areas where, on the one hand, we have been discussing, as you say, the capital markets union, the banking union for many years. All of those things integrate into what we call the savings and investment union. We can see progress in many elements of those portfolios quite soon. Frankly, I think it's quite existential to do so, because if we look at it practically, for the people who are watching the show, A startup in Europe cannot scale up quickly enough. At some point, it necessitates American investment, for instance, at mezzanine funding. Why shouldn't we have the option of having European funding at the same level? It's one of the things we're discussing today, actually. We have the Cookies Noyer report discussed today at the Eurogroup, where we're going to see how a startup can grow in Europe much more quickly than what it does today. This is a core element of what the SIU is.
And is it easier to make progress or to envision making progress on these pan-European sort of initiatives in the absence of Viktor Orban? How do you think that changes the dynamic at the European level?
Well, it's good to have European governments that are pro-European, let me put it this way. And in this regard, I'm very much looking forward to collaborate closely with the new Hungarian government. We're actually in discussions about a potential visit in Hungary on behalf of myself and my team. And was quite happy to listen to them say that they're interested in joining the euro. Obviously, we want a further expansion of the eurozone. We had Bulgaria joining in at the beginning of the year, and we're very much eager to see more countries joining in, should they meet the criteria. So we're quite eager to collaborate with them.
Are you able to establish a sort of timeline for potentially joining the euro for Hungary? Is it too early?
We're not. It's too early to say.
And just a final question in terms of market stability, and something that you've been thinking a lot about is AI. We've been talking about the Mythos model. It's been a big issue and concern over in the United States. The Federal Reserve. I spoke to Deutsche Bank last week. They wouldn't say whether or not they've had access to the model. How important is it to get access to these models for the sort of financial standing of our banks?
What I can tell you is that the discussion on AI is existentially important to the level that renders it probably the most important thing that we will be discussing this year and in the coming years. The thing is that the changes on the AI field are exponential, whereas we think linearly. And the problem is that the accusation that political systems and politicians typically receive is that they react sublinearly. This is going to change everything in the coming years, from both a security standpoint and from an opportunity and productivity standpoint. It's both a moon race and a nuclear arms race. It has both elements. So in this regard, we need to be able to have an acute understanding of what is happening on the ground, and this is why we're bringing it at today's discussions and in future discussions as well.
Well, Kyriakos, Pierrakakis, they're setting the stakes for us. We're between the sort of moon race and the nuclear race. They're the Eurogroup president and Greek finance minister. Guy, Tom.
Ollie, great stuff. Fantastic conversation. Setting us up nicely for the week ahead. Bloomberg's Oliver Crook joining us from Brussels. Let's talk about what is happening with that oil story. Oil bosses certainly weighing in on the impact of the war in the Middle East.
It's early into this conflict to be making big changes. We don't know how things will be resolved. You could build a scenario where things get resolved quickly, the strait reopens, and we get back into a market that's pretty well supplied. You can build another scenario that says this goes on and the market's tighter and it looks different on the other side of it.
Mike Wirth speaking there during the earnings call Friday. Over the last few minutes, Iran saying it will strike US forces if they enter the Strait of Hormuz. We're not there yet. This is Bloomberg.
We are 13 minutes away from the opening trade there. In European markets, futures pointing higher by around 0.2%. It's been a very solid session in Asia, once again near record highs. You had a record close on the S&P 500 and the Nasdaq 100 on Friday. It's a bank holiday, of course, here in the UK, so no FTSE trading, of course, no UK markets trading. But currently, across the European picture, modest gains pointing to upside of around 0.2%. We're looking at DAX futures currently flat. CAC count is looking to add just 14 points, Guy.
Mark Cudmore is back from the United States and joins us now. 3 minutes on what the market is thinking. Might take a little bit longer this morning. Anyway, let's figure out exactly what is going on. Mark, great to have you back. Great to have you back from the United States. Talk to me about what is happening here, because at the moment it appears we have two trades that are on. One is the oil trade and the other one is the AI trade. And the Venn diagram doesn't appear to overlap right now. Does it? Should it? Will it?
I don't think it will overlap massively. Of course, everyone goes that the AI trade is ultimately an energy trade, but essentially they are price setters, so they can just pay the costs and kind of pass them on, or at least that's the narrative at the moment in AI. So even though you'd think that there's a massive overlap and people have tried to play the AI trade over the last year, even long before the conflict, through the energy angle, they don't completely overlap right now. I think the AI theme is much more important. For the last year, it's been all about AI and everything else has been kind of secondary. And it took us a while to kind of register that, all the noise around trade tariffs, everything else, all secondary to AI. Now, for the last last 2 months, or maybe less than that, for maybe only just from March, we temporarily got distracted from the AI theme to focus on the Iran conflict. But since ceasefire was declared at the start of April, we've been back on the AI trend. Now, does it stay that way for the rest of the year? I'm not convinced. I think there's two things to think about. I think one is, obviously, if the narrative in AI changes suddenly, then the backdrop otherwise is more negative. And therefore, you shouldn't rush to buy that dip if it turns negative on AI. Not if it turns negative on other reasons, people will still buy the dip. So I think that's one kind of narrative there. The other thing is that if the Iran conflict, because there's still no resolution, if it really kind of flares up again, because that's seen as the only off-ramp is for the US to re-escalate, well, then that will come back onto the kind of radar and kind of steal the limelight again for a few weeks while we get through that.
Mark, when do higher yields become a problem for equity markets?
You know what? Not right now, not while we're so focused on the AI theme. What they're doing is they're eroding the background fundamentals. So they're making the dynamic much worse if and when the AI narrative changes. But they're not going to be the catalyst in isolation to change that story. And I think, unfortunately, we do have a real stagflationary impulse coming through from the conflict in the Middle East that's going to continue to feed through the data. But again, that doesn't change the narrative alone. AI is the most important story. What it just means is that, last year, if the AI story took a bump, you bought the dip rapidly. You knew it'd be temporary. The underlying fundamentals were so bullish until the Iran conflict. What's changed is the underlying fundamentals are not quite so bullish. They're still pretty constructive. And therefore, if the AI narrative turns suddenly, well, then things could really fall quite powerfully. But again, you don't want to preempt that.
Mark, you've just come back from the US. How different is the view of US investors on what is happening in the Gulf versus what the rest of the world is seeing in the Gulf?
Yeah, they've been much more relaxed about it. I think correctly so. Remember, they are much more insulated from the direct effects, and they're energy exporters. So in many ways, their companies are more oblivious to this. They are starting to realize there's not an easy resolution, and the energy impact is starting to feed through over there. So they're suddenly turning more negative over the past week or so.
OK, Bloomberg Markets Live Executive Editor Mark Cudmore. Mark, thank you. Remember, you can get up-to-date insight and analysis, of course, from Mark and the rest of the team. Just go to MLive Go. MLive Go on your terminal. Let's get your stocks to watch now with Louise Moon. Louise.
Good morning, Tom. So first up today, we are looking at European auto companies. Of course, the big news that Trump has said he's going to raise tariffs on cars and trucks imported to the US to 25%. So he's saying, based on the fact that the European Union is not complying with our trade agreement, we will be raising that to 25%. So details are somewhat slim in that sense, but this is all part of Trump kind of trying to bring production to the US. So companies that make those cars in America won't face those tariffs. So there are quite a few of those. We've got Stellantis, Volkswagen, Mercedes, BMW, all have quite significant facilities in America, so potentially wouldn't be hit as hard. But of course, they've had a volatile year dealing with this kind of whipsaw trade policy from Trump. So we're keeping a close eye as markets open there on European autos. The next big sector, of course, that we're looking at is tech. It's almost day two here. We had obviously the huge megacap earnings last week on Friday in America. They came in very strong. Shares in Asia rallying this morning, all on the back of tech on this AI story. And so we'll be keeping an eye on European chip stocks. The market, of course, was closed in Europe on Friday. So we're expecting a bit of reaction. They've had a really strong year. We've got ASML, ASM, Infineon, all of them really strong year so far for them. So keeping a close eye. And we've also got Infineon earnings this week as well. And then finally, a quick one on ThyssenKrupp, the German company. Now, we'll be keeping an eye as it opens. It's had an OK year so far, up about 28%. But talks have been paused with Jindal Steel, an Indian company, to buy ThyssenKrupp or take a stake in their steel unit. So they've been paused, originally made an offer in September. A bit of doubt as to whether or not that would come through, and now being paused. But some positive news for the company itself, saying that, things are looking a bit stronger. So potentially could be a positive story for them at open.
Louise Moon, thank you very much indeed on some of the stocks that could be on the move this Monday, with the UK market, of course, closed. There was meant to be less event risk this week, given all the event risk of last week, the central banks and the earnings and the geopolitics. Geopolitics is still front of mind, and then the AI strength again being reflected in the Asian session.
And again, it gets more concentrated, and that's the risk that everybody's trying to figure out exactly how they play right now. How do you invest into this? Can you keep pace with what you are seeing in the markets, particularly if you're a fund manager? If you have constraints around your portfolio, can you own all of this stuff? How much do you have to balance out the risk with that? It's a minefield for portfolio managers at the moment as this story gets tighter and tighter.
It was very much a debate, wasn't it, of 2024 and 2025, the narrowness of the gains and when you were going to get that breadth. But it didn't derail. Ultimately, it didn't derail the overall direction of those markets. So is this more hand-wringing, or is this a relevant question as we see the gains coming through?
I think it's just tough if you're a fund manager. How do you keep up with the market? How do you justify your position if you are in a position where you are having to chase these markets? How do you get ahead of it? Anyway, the opening trade is coming up. London is closed today. You've also got Tokyo and China closed today as well. Factor that into your thinking when you watch what is about to happen. European markets called broadly higher, but only a little. We'll deal with the details in just a moment. This is Bloomberg. A few minutes to go until Europe reopens. Now, remember, the timelines are all messed up. A lot of Europe was closed on Friday. You've got the UK closed today. You aren't going to get Treasury trading until later. You've seen yen intervention. There's a lot going on, but it's hard to get a kind of clean read on what is going on with European stocks as a result of the Friday closures. The S&P, this was Friday's session, a bit of a drift sideways after a move up first thing. The story out of Asia overnight has been fascinating. Tech stocks have been absolutely flying, which has been, again, a theme that we are constantly talking about. So here you go. That's the session. That's the session out of the United States Friday. Europe was largely closed, so you've got to kind of think about Thursday, Friday when you think about what Europe's got to do this morning. Stock 50 futures are up by around 0.3. CAC, a similar sort of story. The DAX is absolutely flat. Keep an eye on what happens with the car sector today, Tom. That is going to be a narrative that we're going to watch very closely on further threats of further tariffs.
Yeah, so we'll watch those auto stocks, absolutely. 25% from 15% in terms of the tariff hit is what President Trump is threatening. Bloomberg Intelligence says the likes of Volvo, the likes of Porsche, the likes of Mercedes are most vulnerable. So we're watching the auto stocks. You mentioned tech, a rip-roaring session once again in Asia with the SK Hynix story, the Samsung story, the Kospi rallying more than 4%, the Taiwanese index as well, up around similar levels. So massive gains right across the board when it comes to those indexes, particularly focused on what's happening in the semiconductor space, of course. So whether or not there's a read across to the European session will be in focus. Umicore, this is a Belgian materials tech company. The group expects its earnings to be significantly higher than the estimates. So that is potentially bullish for Umicore, another stock on our radar today, Guy.
OK, here we go. Time for the market open. You've got to think about Thursday and Friday in terms of what you're factoring into your thinking for European equities this morning. Lots closed Friday. The UK is closed today. Again, that's going to dampen volume. We've taken the FTSE off this board, obviously, but we have a story that we're going to watch very carefully out of the AEX this morning. I'm not sensing that this is going to give me a clean, quick read on what is happening here. I'm looking at a lot of grey. Here we go. Stock 600 is beginning to price what is happening. I would expect the IBEX and maybe the CAC to give me a price next, but I'm not sure that this is going to be a quick narrative that I can give you. There's the CAC. Or particularly a significant narrative, if I'm being honest. The AEX up 1/10, the IBEX is up by 0.2%. The DAX will have to wait. Anyway, Tom, save me. What have you got?
OK, across your sectors so far, and again, this could adjust, of course, as the pricing comes through. And just reflecting on the indexes before I get to the sectors, the FTSE Mid then up 0.2%, a stronger session so far for the IBEX, up a little over 0.2, and across the benchmark, you're currently flat. On the sectors then, tech is at the top of the list, up 0.7%. On the downside, as we had flagged, is autos, currently down 0.9% on that tariff risk that came through late Friday from President Trump. Chemicals also down around 7 cents. Utilities taking a bit of a knockdown, 0.3%. But the biggest losses coming through for autos, down 0.9%, and tech, the biggest gains right now, up just shy of 0.6%. That's the kind of sector breakdown as the pricing comes through. So the tech handoff from Asia is there for Europe, and then the threat of additional tariffs on the auto sector, guys.
Big names going XD today. So BASF is at the top of that list. So
that's the chemical story.
That's maybe a bit of chemicals.
Yeah.
Danone, RVA, Continental, Alt Score, all going XD this morning. So just kind of factor that into your thinking when you're looking at what we are seeing on our screens. But it's interesting. SAP rallying this morning. ST Micro's up quite nicely. From a points point of view, though, Nestlé's also coming back. I'm always loath on a day like today to read too much in terms of the early price action, because effectively most of these markets closed Friday. You're kind of all the way back to Thursday in terms of where you're taking some of your pricing clues, plus Friday. Then you've got the Asia session to fold in. So let's let it settle down, and then we'll get maybe a better idea.
I think that caveat is very wise. VW down 1.7% with that caveat. BMW down 1.7%. Mercedes as well, close to 2%. Again, you can tie that to the tariff risk. On the top, as Guy was saying, ST Micro gaining in terms of the tech story, of course, with that company in focus, currently up around 3.4%. Let's get another take on these markets then, and bring in Dan Scott, CIO and multi-asset head over at Vontobel Asset Management. Dan, good morning. Thanks for joining us this Monday. Guy is very worried about fund managers. He feels sorry for them in terms of how to navigate this environment. How are you feeling? What is guiding your moves in an environment where you are seeing AI red hot, but all the geopolitics and the inflation risk out of Iran?
Well, you sum it up nicely, right? I mean, those are the fat tails. You have geopolitical risk on the one side, and then you have the AI capex boom and tech stocks, supported also by fiscal stimulus, that are driving equity prices and a very benign backdrop for equities. So right now, I'd say the focus is on corporate earnings, and we're kind of ignoring the geopolitics, but they're there, and they can derail things. And I think that's why you see things like bond yields where they are, at the same time as equity prices continuing to hit highs, because you have this situation where corporate earnings are very strong. I mean, from the tech side, you saw Mag 7 with blowout earnings in the US, but you also had pretty strong financials. And then here you're showing auto prices, right? That's the geopolitical terrorists here with threatened tariffs again. So that's the tricky situation that we're in. We're all looking at the strength of the consumer. Does it hold up? How long is the strait going to be closed? How much of a feed through is this going to have on tariffs? What does that mean for rates? Those are all questions about where we're going. And where we are, what's being reported from corporates is actually record high margins. So that's kind of where we stand right now. And when we take a look at the broad macro, we'd like to think that the Strait of Hormuz and oil prices higher are a look-through event, and that longer term, we're actually still in a fairly bullish macro environment.
Dan, what would you have to see to come to the conclusion that it is no longer a look-through event?
Well, the longer it takes, the more the feed-through that you have, oil through the rest of the complex and feeding through other areas of inflation. My issue is that central banks are kind of powerless at this point. I mean, hiking interest rates is going to create some demand destruction, of course. But, higher oil prices also create demand destruction. So the nice thing about oil prices is that, the best fix for high oil prices is high oil prices. They fix themselves. It creates its own demand destruction. So you don't need to tighten financial conditions, really, to bring oil prices lower. So I think it would be a big policy mistake, in fact, if we have it as the market's pricing that the ECB is going to come forward and hike interest rates. Because as you see with this tariff threat, Europe has its own issues. It's also fairly energy dependent, much more so than the rest of the world, which is why you've seen actually Asian equities continuing to be successful, leading gainers internationally in terms of equity regions, and Europe starting to struggle because of its energy dependency. So, to try and hike interest rates with a view on inflation is probably going to do more damage to the economy than it's going to do helping energy prices come down.
Dan, so what do you do? How do you manage all of this? What does a portfolio look like at the moment? Do you have to factor in the risks, or do you just run with the tech story and assume that we are going to be able ultimately to see that power on? Are you risk on or are you risk off? What are you doing within portfolios at the moment?
Oh, so we remain overweight equities. We have an overweight that's expressed through an overweight in Europe and emerging markets. The emerging markets part is working well. Europe did for a while. It's now flat, lagging, and neutral the U.S. And we finance that by being underweight bonds, not necessarily that we're so negative bonds, but we just feel that the risk skews more to the upside on equities than it is on fixed income. And otherwise, in terms of a hedging for the portfolios, we have a significant allocation to liquid alternatives, and that being things like, catastrophe bonds, gold, commodities, these sorts of things that we're trying to give ourselves convexity in our portfolio. Longer term, I'd have to say that this bucket of liquid alternatives keeps being a bigger portion of the portfolio than fixed income is, just because fixed income is quite tricky, right? Government bond yields where they are pose a bit of a threat to equities. But if you look at the spreads, narrow spreads of high yield or investment grades to govies, it shows you a lot about where markets, fixed income, feel the risk is.
Okay, there's 2 points that are probably worth taking out of that. Let's come back to the equity portion first of all. What would it do for you to change that allocation to Europe and the allocation to the United States? Because I'm hearing a lot at the moment about the fact that US exceptionalism is back, that you don't want to have money being put to work in Europe. How close are you to changing that thinking?
So for decades, I'd say, Guy, most of our professional careers, being invested in U.S. equities was a great bet, and you were really never paid off by being short U.S. equities because the earnings growth superiority of U.S. companies always compensated you for the dollar's decline. The dollar remains in structural decline, especially against safe haven currencies like a Swiss franc. But what I'd say now is that it becomes increasingly difficult for U.S. earnings to compensate you for those declines when you have years like last year where you had 10% down trade weighted on the dollar. So, unless you're talking about the pockets of their areas where there's been real growth, like in tech, U.S. earnings are not necessarily going to be such a easy win. And I think that there's a lot of cyclical catch-up in places like Europe for valuations to close so that short term there's more opportunity in Europe. But for Europe to perform, we need to see oil prices coming lower. We need to see the Strait of Hormuz opening. We need to see Europe finding alternatives for energy. Asia remains quite strong. So you have the tech exposure, the strong exposure to the AI trade in Asia, coupled with relatively low valuations that are very bullish for those equities. And then you have the commodity exporters within emerging markets that are in a pretty good place. And in fact, you have some central banks in those countries that are actually in an easing bias. So I think EM does well no matter what this year. And as long as we have an eventual opening, which is still our base case, then you have global growth picking up and you have those cyclicals catching up.
Dan, there was a couple of points around your view on the US longer term, or at least medium to long term, in terms of the potential downside risks for the US equity story. One was the dollar. And what you seem to be nodding to that concentration risk, again, around AI and tech. Is that how you see it? And are you now starting to... Are you assuming a structurally weaker US dollar following this conflict?
Oh, structurally weaker? Yes. So long-term, dollar is in decline. I think that's part of the game plan. I think, inflation rates at around 3% are actually the real targets because it helps with debt levels. It wasn't so long ago that we were talking about a potential new Plaza Accord. So, look, I think that's how you try and deal with the trade imbalances and deal with your inflation, is to weaken your currency. It's not necessarily such a bad thing as long as inflation expectations don't completely disanchor. And right now, when you look at five-year forwards, you can see that inflation expectations are still fairly well anchored. So I think that's the game plan for the U.S., weaken their currency. And do you see yields going up in that in that environment?
Like, how much higher? We've got a US 10-year 4.4, let's call it, rounding up a little bit. You say that bonds aren't on the kind of the other side of the portfolio right now. How do you see the bond market story developing?
Yeah, look, so what's happening right now is that the market, especially after the last FOMC meeting, right, is that where we have a high level of dissent and wanting to get that wording easing bias out is starting to price in the possibility of taking out the easing bias and maybe even a rate hike. We don't see that happening. Our base case is still for a September cut of 25 basis points. So I think that the market's got that a little bit wrong. I don't think it would make any sense. I think the focus is going to be on the job market, and the job market is not necessarily that strong. It's just very tricky at the moment with this K-shaped economy where you have the top cohorts of the income of those earners, top cohort of earners driving consumer spend. Hiking interest rates hits exactly the other end and won't necessarily help. So I think that the bias goes towards easing, and then we're talking about a rates differential story where you have the US easing and Europe not easing, probably just staying on hold, and that, of course, is then further downside pressure on the dollar.
Dan, let you get back to work. Thank you very much indeed. Dan Scott, CIO and multi-asset head, joining us from Vontobel Asset Management. Core 6, let's take a quick look and see what is happening this morning. I hope there's no UK stocks in here. No, I don't think there are, actually, which is interesting in itself. But broadly, you've got a fairly flat picture developing. What we are, though, is watching an auto sector that is having a very tough time of things. Louise is here with them all.
We are indeed. This is, of course, after the story that Trump is raising tariffs on EU car imports. That's to 25%, really weighing across the board in the sector. Now, he said that cars made by these companies in the US won't obviously face those tariffs, and a lot of these have exposure. So Mercedes and BMW, for example, have factories in the US, so you would expect them potentially not to be as hit, but of course, you know, weighing across them, still not giving them much of a boost there, despite those factories in America. So keeping a close eye on autos through the day. Next up, we're looking at tech as part of this kind of AI story that we're seeing globally. You know, Asia rallying on the back of this, and seeing that play through this morning as well here. Nokia up over 8%, Infineon just over 1%. They've also got their earnings this week as well. ST Micro and BE Semiconductor as well, all rising across the board. So we're seeing this play out globally, and we'll of course be keeping an eye later on as America opens. Next up, we have Umicore. Now take a look and see how their stocks are doing. Up over 11%, almost 12% into the green. That's after their guidance beat estimates. They've already had a strong first quarter. Guidance beat estimates. Analysts said they expected this to play through into their share price movement, and we're really seeing that this morning. And finally, ending in Germany with ThyssenKrupp. Now, talks have been paused with Jindal Steel, an Indian company, to take a stake in their steel unit, but not really seeming to impact their shares. Now, ThyssenKrupp have said that this is because, you know, things are looking more favourable for them as a company themselves. So investors taking that as a bit of positivity despite that pause in talks.
Louise Moon, thank you very much indeed on some of the individual stocks on the move this Monday. Coming up, President Donald Trump brandishing the tariff stick, as Louise was saying, yet again, vowing to hike tariffs on EU cars and trucks to 25% from 15%. So from 15 to 25%, that's the threat. We discuss the risks then for European automakers, their exposure to the potential higher tariff rate from the US. That is next. This is Bloomberg.
$18 past the hour. Welcome back. You're watching the opening trade. European equities aren't really doing very much at the moment. Certainly not doing very much in comparison with what we've seen overnight out of Asia, which was a pretty sensational session. Tech obviously driving a lot of that. Here in Europe, we've got other factors we need to fold in, and one of those certainly comes in the form of the car makers this morning, which are under a little bit of pressure, Tom.
Yeah, that sector's currently down 1.1%. European automakers then moving lower this morning after President Trump said he is raising tariffs on cars and trucks from the EU to 25%, claiming the bloc has failed to fully comply with the trade deal between the two sides. Bloomberg EMEA Autos editor Stefan Nicola joins us from Berlin. Stefan, what is President Trump accusing the EU of doing or failing to do?
Yeah, President Trump is accusing the EU of being too slow in adopting the trade agreement from last July. The EU at the time agreed to remove basically all tariffs on U.S. industrial goods, including autos, and in turn accepted a 15% tariff from the U.S. And of course, Trump is unhappy with slow progress in the EU. We know that this is a familiar stick Trump is using in tariff negotiations. It feels a bit like Groundhog Day. We've been here before. Let's see what comes next.
Do I have to wait to see whether this is real or not real? Is that what is ultimately going to define the EU's response here? Is it actually, does this need to become real for the European Union to respond to this?
Well, of course, any threat by Trump is real and not real at the same time. But what is clear is that the EU is trying to de-escalate for now. The European auto industry has asked or has made statements that sort of suggest they want to de-escalate. And I think we'll have to see what the next days bring. I'm pretty sure that contacts below Trump will be exchanging views there and exchanging options. The EU has already said it's sort of, ready to sort of fast track adoption. But yeah, Brussels is a slow moving tanker. So it's not an easy debate here.
Stefan, if we assume that these tariffs come into place, 25% from 15%, what would that mean materially then for European car makers?
Oh, yeah, that would be bad news for European car makers. It would reduce operating earnings by anything between 12 to 20% for some companies. Some firms have already factored in some tariff relief in the first quarter, Stellantis to the tune of 400 million euros. So this adds cost, this adds complexity. It would be bad news for European car makers.
Stefan, thank you very much indeed for the update. Stefan Nicola joining us on what we're seeing in the car sector this morning. Let's turn to what is happening in tech. We've certainly seen a big rally overnight out of Asia. Maybe a reaction to what we saw Friday out of the United States. But nevertheless, we have seen that holding up benchmarks in Asia, despite what we're seeing in terms of the war in Iran. All-time highs on many indexes. The moves, of course, come after we see the S&P extending that record-breaking streak through Friday. Joining us now, Neil Campling, Bloomberg senior strategist. Neil, is it just a reaction, what we've seen out of Asia, to what we saw out of the United States late last week, or is there more to it?
There are stories around an acceleration in physical AI around Nvidia's ecosystem, which is an additional driver for Asia in particular, but it is more of the same, to be honest. It's like we're looking at the Asian markets are very hardware-centric regarding the AI trade, whereas in the US, obviously, there is the hardware, there's the software, there's the enablers, there's the users. So within Asia itself, it's very much the hardware, and the stocks are the enablers of the ecosystem. So Nvidia doesn't exist without TSMC chips. The memory trading South Korea, in terms of Samsung and Hynix, are very much the provider of the memory chips that go into the hyperscalers' data centers. So that explosion in the capex that we're expecting now, above $700 billion for this year for the hyperscalers, that's helping to fuel the rally in the stocks in Asia that are geared into that capex spend. And that appears to be what's taking place. And then the additional element to that as well is that in the Asian markets, in Korea and the Kospi in particular, there's a very heavy retail element to the buyers of the stocks as well. And I think that's probably adding additional juice into what's going on in those markets.
Is the valuation story still looking attractive for those stocks over in Asia with that exposure to the hardware and the AI story, Neil?
Well, we saw from Samsung's memory division results last week, it was something in the region of like a 45-fold increase in profitability for the memory business. So that actually means that for many of the stocks that you're seeing in the AI trade, and this is true for the US as well, is that valuations don't look extreme because the earnings growth is so powerful at the time for the time being. So we're not seeing necessarily the extremities of the valuations that you might worry about being a sort of the end of the cycle. So really there is a combination here of the huge growth, which is in turn applying to sort of reasonable valuations for the time being. The one caveat to add to that, Tom, is that when it's regarding memory, these stocks in history have always been cyclical, so they tend to have a lower valuation than you would have from kind of the key enabling technologies.
Neil, just talk to me about what positioning looks like right now and who's buying tech? Who is it that's buying? Is it retail? Is it the hedge funds? What are the CTAs doing? What is the setup going into this week?
Yeah, great question, Guy, because the information we get from some of the color on the prime books, for example, is actually showing that hedge funds have been the biggest net seller of tech stocks in the US over the last 2 weeks. So they've been taking advantage of these big moves to actually lighten their positioning in tech. I think it's the second biggest move lower in tech positioning by those hedge funds in the last 10 years, the only other time coming after COVID related. The CTAs appear to be, the momentum followers tend to be sellers of global equities for the first time in a couple of months for the following week, regardless of the market tape being up, down or sideways. So I think the incremental is coming through perhaps at the moment likely from retail, and then you've got the additional of buybacks, corporate buybacks, which is supportive. And I suppose an expression, in a way, of the retail frenzy and interest is the incredible story that came over the weekend about GameStop preparing to make a bid for eBay, which is quite astounding.
Neil, thanks for the update. Covering all bases. Neil Campling, Bloomberg, senior strategist. What are we going to do next? President Trump says the US will begin guiding ships out of the Strait of Hormuz. We'll deal with the details of that next and get some analysis. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. It's Monday. The UK is closed with a bank holiday. Across the benchmark in Europe, you are flat. A little bit more interest below the hood, and you're seeing that certainly in terms of the auto sector, which is under pressure today on the tariff threat. Despite that, the DAX is up 0.2% over in Germany, getting 57 points. Losing 26 points is the CAC 40 over in France, currently down 0.3%. Tech, the last time I checked, was top of the list in terms of sectors. On the downside was autos. Guy, what are you seeing?
London is out. You want to see the impact that has? Let me show you. Volume is down by nearly 90%. So that just tells you in terms of the impact that we are seeing, what effect that is having. In terms of the breakdown, 240 are up, 212 are down. That is what the Stock 600 story is telling you. To be honest, park this board. Let's take a look at some of the leaders and the laggards. Nokia has not been this high since 2010. Look at this. We're at a 16-year high. The stock this morning is up by 8%. Umicore out with numbers this morning, absolutely smashing it. This is the material science company. It is up by 15.3%. Cinch is also up. I think this is following a rival and posting good numbers over in the United States. That's lifting that stock by around 20%. The downside, though, is worth really paying attention to this morning. Take a look at what is happening with, in particular, German auto stocks. You've got Mercedes, you've got Conti, you've got Porsche, all, as you can see, being pushed lower this morning to varying degrees. Mercedes is down by 1.25. Conti's down actually much more than that by 4.24%. Porsche is down by 1.6%. The mere threat of more tariffs is doing this. We haven't actually seen the reality of more tariffs, but the mere threat is sending European auto stocks sharply to the downside this morning, Tom.
Yeah, we'll be getting more detail on that, of course, in the minutes and hours ahead as well. Here's what else you need to know this morning. 3 people have died and 1 is in intensive care in South Africa after a rare outbreak of hantavirus on a cruise ship. The vessel involved is the MV Julius, which is currently off the coast of Cape Verde. The World Health Organization says lab testing has confirmed 1 case and 5 others are suspected. President Trump says the US will begin guiding some neutral ships trapped in the Persian Gulf out through the Strait of Hormuz. US Central Command said Sunday it would provide military support, including guided missile destroyers, aircraft and drones. The Wall Street Journal, however, has reported the plan does not currently involve Navy escorts. And GameStop is making an unsolicited offer to buy eBay for about $56 billion at a $125 a share in cash and stock. In the proposal, GameStop CEO Ryan Cohen would serve as CEO of the combined company. Guy.
OK, let's get back and talk about what we are talking about in Brussels and in Armenia today. EU finance ministers gathering in Brussels, at least today. They're looking to address the impacts of the Iran war on the European economy. It comes, of course, amid escalating tensions between the US president and European allies, which Trump is using to threaten deeper cuts to the military presence in Germany and potentially elsewhere, and talking about imposing that 25% tariff on EU-made vehicles. How is Europe going to respond? Let's try and find out. Let's go to Brussels. Our correspondent, our chief Europe correspondent, Oliver Crook, joins us from there. Let's talk tariffs first of all, Ollie. What's behind this latest threat?
We don't really know, guys, the truth of the matter. I mean, we got this tweet out, or this truth out, by the President of the United States saying that basically the European Union had not been complying with the trade deal with the United States, and that as a consequence of that, there's going to be a 25% tariff on cars and trucks that are shipped from the European Union into the United States. That's an increase of about 10 percentage points. The tariff was about 15%. And for the Europeans, they thought this was a matter that was basically done and dusted. They were moving along with the trade deal. The ostensive reason that the United States may have been doing this is because it's taken a very long time to implement this deal on the European side, because it takes a long time to do these things at the legislative process at the European level. There were, of course, 2 delays to the trade deal. The first that was brought on by the Greenland threat and the tariffs that were threatened around that. And, of course, the IEEPA tariffs being struck down by the Supreme Court has added a little bit of time to that. But the real question today in Brussels and across Europe is, what is the appropriate reaction? What is the appropriate response? And that is the question that I put to the Eurogroup president a little earlier. Have a listen.
Needless to say, I think this discussion that's currently taking place is quite unnecessary and quite unfortunate. The last thing the global economy and the European economy needs right now is an extra layer of uncertainty on top of what is happening in the Strait of Hormuz and in the Middle East. If there is a deviation from what we have agreed upon, obviously all choices will be on the table, all options will be on the table.
So all the options on the table, this could be, suspending the trade deal from the European side, retaliating the European side, but it could also be maybe accelerating getting this trade deal over the line. But again, we should say this comes at a time when you're suffering already massively in Europe as a consequence of the energy shock. Germany cutting its growth forecast. Now another hit to the auto industry is probably the last thing Germany needs.
Well, that coming at the time as well, Ollie, as you know, of this threat to withdraw and draw down troop numbers, US troop numbers in Germany by 5,000. But President Trump insisting or suggesting there could be more to come. Maybe Congress has a role here. Potentially still around 30,000 US troops being left in Germany, though that number, it seems, could be adjusted. How significant materially would this be for the US presence in Europe?
A few things to say on that. There's already been the expectation within Europe that the United States would draw down some of its troop presence across the European continent. That is something that has been well advertised by the Trump administration. They want to change their sort of global military posture to be more focused on the Asia-Pacific region. As a consequence, there were always going to be some troop withdrawals from the European side. That being said, the timing of this, Tom, of course, is intensely conspicuous. It comes a couple of days after basically the German chancellor was quite critical of President Trump, saying that he was getting humiliated in Iran, saying that the United States didn't really have a plan to get out of Iran and that the whole sort of production was not going according to plan. And that, of course, a few days later, you get the troop withdrawal from Germany. Now, we should say this is about 15% of the U.S. troops that are within Germany. There are about 35,000 there right now. There are about 80,000 more broadly on the continent of Europe. But again, there's obviously a sort of a military and strategic component to this. Of course, you're less functional operationally if you have 5,000 fewer troops. But of course, the big thing thing is the signal that it sends yet again to the NATO alliance. And the big question for the Europeans, probably the biggest of the Trump presidency, how committed is the United States, is Donald Trump to the NATO alliance? This sends a fairly poor signal to answer that question.
Yes, confirming some of our expectations. Oliver, thank you very much indeed. Oliver Crook joining us out of Brussels. Joining us now is Roxanne von lecturer in international politics on the Middle East at the University of Cambridge. Roxanne, thank you very much indeed for joining us. We now have another effort potentially to open the Straits of Hormuz. There is talk of the fact that we could see the US looking to shepherd ships through that strait. I'm sure you've read in on the details. What do you make of this? Is it real? Is this something that we should talk about seriously?
Well, I think that one can look at it from two different angles. First of all, it has become a pattern that every weekend President Trump attempts to talk down the price of oil and boost the stock market, and he comes up with a positive spin on the relationship with Iran and the situation there. So we're seeing this in the third or fourth iteration, as he now says that he's going to have an escort of some kind to ease the pressure in the strait. This is based, he says, on discussions with Iran that are very positive. The Iranians are saying they're going to attack if any action like this is taken by the United States. So what we've seen is that he's tended to be very positive on Sunday or Monday as the price of oil has tended to go through the roof over the week, and then comes up with this, it drops, and then it starts up again. So we can look at it from that perspective. On the other hand, there has been quite a bit of discussion that there's going to be escalation, and the very idea of putting American Air Force and possibly naval escorts into the Gulf would definitely lead to that. And I think he's looking for some kind of way to frame this as the fault of Iran in shutting off the oil. And we are looking right now at a serious escalation of how much oil lack is out there. We're running 700 billion barrels of deficit, and that's going to be hitting us very soon. And so he has to do something.
Okay, there's a lot in there, so let's break that down. First of all, let's talk about kind of the relationship of President Trump and his relationship with the financial markets. I've spoken to two fund managers this morning, both of whom have told me that they expect a reasonably quick resolution from here, and they expect the Strait to be open in fairly short order. Is that where you would put your money right now? Do you think that we are going to see the Strait of Hormuz opening in fairly short order?
So my money would be that I've heard this before from many American finance people, because I think the hope is that this is going to somehow resolve itself. But I do not see that this is leading to anything but a hotter war, because the retaliation by Iran has been stated that it will be immediate, and we're seeing then the conflict restart.
Roxanne, what are the timeframes that we should be looking at then? Is it worth thinking about the approximate 2-week timeframe between now and the meeting between Trump and Xi Jinping in Beijing? Is it worth thinking about the Iranian capacity to continue to produce oil when their wells start to cap out? What are the kind of timeframe scenarios that the markets investors should be maybe mapping out in this conflict now?
Well, first of all, I think let's start with China. I think this upcoming meeting is looking increasingly conflictual, because President Xi has said that he feels that the sanctions on Chinese teapot refineries, for example, are completely illegal. And this is a real departure from the past. He's saying that all action on that use of refineries should simply go ahead, that in the past the Chinese have complied somehow with the sanctions while stating baldly that they don't agree with them. Well, now he's saying, no, we are not going to comply. So this is a real departure in terms of where the Chinese sit on this. And in combination with the increased furor now that you were just reporting on with the EU, I think what we're seeing is a rise in American isolation and a rise in American action against other markets. So I think the markets are in for quite a bit of a roil. As far as the question you put for Iranian oil, it's not really capping out at the moment. I think that, again, is something that's coming a great deal from the perspective of the United States. But looking at Iran, they've dealt with this kind of thing before. They were dealing with this kind of thing during the Iran-Iraq war and through these many, many decades of sanctions. And they've actually gotten, they say, a way of reducing the amount of oil output and being able to restart it without having to cap. So we're seeing technological development on their part to avoid this.
Who has the biggest and greatest tolerance for pain at this site? The US or Iran?
Well, I would say it's probably Iran has the greater tolerance. It's not that it's not suffering enormously from all of this. I think we are all suffering from this war. But I think the United States is quite protected at the moment from the impacts of the war. Of course, the price at the petrol station is rising. And I think there are definitely effects in terms of the farmers and the lack of fertilizer that is arriving. But overall, the American population is quite shielded from a lot of this. And I think that's going to change in 6 to 8 weeks when, in a sense, what we've got is air in the pipe. We're going to suddenly find that there is no oil on the seas, and there's no oil that's coming. And the result is that all of us are suddenly going to go into a real crunch. There won't be flights. There will be shutdowns. And that's when the global market is going to be facing something that we haven't seen. And we're going to have to all adapt. And the Americans will have to adapt to that, too. And, of course, he's got midterms coming up. So that's got to technically change if he expects to have a positive outcome for those elections.
Just in terms of the kind of the timeline we're looking at here, once that moment arrives, does that speed up the resolution of the process? Or does that just place the Iranians in a position where they feel that they have a reason to continue? What does the timeline look like after getting to that point of realization?
Well, I think it's very difficult because we do not easily anticipate what President Trump responds to. So at the moment, his response to the third round of negotiating points, Iran put forward 17 points. The first one simply, the first phase that they've proposed is to stop the war, to completely stop the war. So if we get to that, I think all of this then starts down the correct way of resolution. But his response was that they haven't paid enough. And however he is measuring that, the negative commentary that he made on Friday, the markets went up in terms of the oil prices, and it's possible that the response has been very negative. So we are seeing him constantly juggle, and the result is really hard to tell exactly what a time frame will look like.
Roxanne, thank you very much indeed, as ever, for your insights today. Roxanne Farmian, lecturer in international politics of the Middle East at the University of Cambridge. Coming up, the collapse of Spirit Airlines, which ties into that story, of course, partly at least, is causing pain for passengers in the US. That is next. This is Bloomberg. Welcome back to the Open Trade. Briefly checking your markets for you. The UK, of course, is closed for a bank holiday. Across the benchmark, Stock 600 is seeing modest gains of 0.1%. Autos under pressure. Currently, that sector down 0.7%. Tech, though, on the upside, gaining today. The DAX over in Germany up 0.4%, despite the pressure on some of those big auto names.
OK, let's talk about what's happening in the airline sector. Over the weekend, the big news in the aviation space was the collapse of Spirit Airlines. Cascading through airports across the United States, passengers left stranded mid-journey. Rival carriers obviously had to go into response mode to try and contain some of the damage that we have seen. Is this emblematic of what we are going to see on a wider basis as a result of the fuel shortages we're getting, or is this a Spirit problem? Let's try and find out. Bloomberg's managing editor for aviation is Benedict Camel. Benny, bring us up to date on what happened this weekend and, more importantly, why it happened.
So Spirit is a company that had been in trouble even before the fuel prices went up. So you could say that the root cause for their collapse, which happened over the weekend, was established long before the Iran war, but it really sort of amplified everything. It brought everything really into focus, and it shows that if you don't have a buffer, a financial buffer, as an airline, as a company, you're going to be in trouble very quickly. There were obviously attempts to save the company. President Donald Trump obviously got involved in this and said that they could do this. He didn't want to see 14,000 jobs go away. Nobody really liked that idea because people thought that they were throwing good money after bad, that this ultimately may not be a company worth saving. And then in the end, it was lights out over the weekend for the company, and they're now stranded. What this means for the larger industry is there's one player that is gone. The assets, and there are considerable assets, it's more than 14,000 employees. It is 2,000 pilots. It's more than 200 aircraft, and there's a lot of valuable slots in popular places. Those will probably get fairly swiftly absorbed. There was some blame game over the weekend. Whose fault was it really? Was it the Biden administration that didn't allow Spirit to come under the protective roof of another partner? Or was it really something that was sort of rooted in the company itself? So that will probably continue in the next couple of days.
And as you suggest, Benny, jet fuel was a factor, not the only factor, clearly, but a factor that possibly kind of was the straw that broke the camel's back for Spirit. What else are we hearing from other airlines as they grapple with higher fuel costs?
Well, this has certainly been a big theme for the industry in the last couple of months, since the end of February when the war broke out and really resulted in this spike in fuel prices. You have to remember that the aviation industry has wafer-thin margins to begin with. In a good year, they manage around 6 to 8% in an operating margin, which really isn't a lot. If you compare that to tech or any other industry, these are airlines. This is an industry that is always sort of operating sort of on the edge of the cliff financially, and if something like this happens, it makes life very difficult very quickly. Those that have come in stronger are able to absorb this, but they're also absorbing this partly by passing on the ticket prices to the customer. If you're a low-cost, ultra-low-cost company like Spirit, that is going to be very difficult because there's really nowhere you can push these ticket prices. People expect rock-bottom prices to begin with. There's very little appetite to add more to that. So that's probably the segment of the market that is hit first. Over here in Europe, it's a little different. If you talk to Ryanair, if you talk to EasyJet, these companies actually say that they are somewhat net beneficiaries of this because people will be more frugal, will be more sort of budget-minded, and they can serve that kind of a market. So it's a little varied wherever you look, but overall, this whole crisis, the war, has been bad news for the industry.
Bloomberg's Benedict Camel in Berlin with that important update. Benny, thank you. Let's look ahead to what else we are watching throughout the week today. Of course, the Eurogroup meeting is taking place in Brussels. Oliver Crook is on the ground for us. On Tuesday, it's the ECOFIN meeting, also in Brussels, plus European bank earnings from Unicredit, HSBC and Banco de Sabadell over in Spain, of course. And on Wednesday, the G7 trade ministers will be meeting in Paris. Tariff threats, of course, from the Trump administration, no doubt part of the conversation there. Bumper earnings as well on that day with results from the pharma, consumer and tech sectors. That's on Wednesday. And on Thursday, UK local elections in focus for us here, certainly. And on Friday, it is non-farm payrolls, US jobs reporting on Friday, that data crossing. Joining us now for more on what to expect this week and how investors should be thinking about some of those risk factors, Bloomberg macro strategist Ven Ram. Ven, what is top of mind for you right now as we look at Asian markets near record highs? The US closed at record highs, of course, on Friday. It's diverged from the European stock story. But what for you is top of mind across these markets?
Morning, Tom. I think that, the two big factors, the two big data points that I'll be watching is one is the Treasury refunding announcement. And as you know, they've been deferring sales in the longer parts of the curve, and they've been pretty much funding all their needs from the shorter term T-bills. I don't think that can continue for too long, especially in this volatile environment, because sentiment can shift from one auction to another. And if you're doing short-term bills, then you're having to roll them over very quickly. And therefore, I don't think the Treasury wants to take the risk of, an abrupt change in sentiment, given all that's happening in the Middle East. So that will be one factor that I'll be watching. The other thing, obviously, will be the non-farm payrolls data. We are forecast to get a 62K net addition to jobs. And I think that the Fed will take that because, they have penciled in growth of 2.5% for this year. And if you take that with core PCE, I think the question before the Fed is, should they actually be cutting rates or should they be thinking of raising rates? So a very interesting juxtaposition of data this week. And of course, you've got the US stocks surging all this while without defying gravity. So it sets up a very interesting backdrop, Tom.
Ben, in 45 seconds, how do I think about the gilt market going into the local elections later this week?
Well, I think that you've got to add a political risk premium into Gil's guy, because so far the markets have been thinking this is a pretty inflationary problem, and they've been pricing in an inflation premium to the curve. But I don't think there is too much of a political premium that has been added. And why do I say that? Because if you look at the pound, it's been pretty resilient despite all the accusations against Starmer and his government. So I think that if we see a setback in the local council elections, I think that the pound will cop it, and so will gilts.
OK, Bloomberg macro strategist Ven Ram on the potential political risk and what is factored in as we lead up to those local elections on Thursday, with potentially significant consequences, of course, for the UK Prime Minister. European stocks currently across the benchmark are flat, Sky.
Absolutely. Waiting for a little bit of volume maybe a little later on in the session as the US returns. The UK market is out today, certainly having an impact. I think Bill Ackman's going to be on Bloomberg Television a little bit later on. We've got the Milken Institute conference. He's going to be joining us at 5:30 p.m. London time. That is it. I shall wrap the show up. But Tom will continue. He will be joining you momentarily on the Pulse to continue all the market action you need to be paying attention to. We're all looking forward to that. This is Bloomberg.